going on, guys? Welcome back to another video. So in this one, we're going to be going over this really significant margin call issue that's been happening globally at this time right now. And we also have some interesting developments on the entire market in the Bank of England's quantitative easing plan that is absolutely backfired in their face. Now, again, we do have an absolutely crazy week ahead that we do have to talk about to make sure that you guys are prepared for. And we have some comments from Jamie Dimon, the CEO of JP Morgan, basically issuing some pretty interesting statements about where he thinks the markets are going to go over the next couple of quarters. So again, guys, before we get into all of that information, if you do enjoy the information and analysis that I provide for you guys in these videos, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who actually want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So let's get right into the charts over here and take a look at SPY, the SP500 ETF on the 4-hour time frame. So as you guys can see right here, we are just hanging on by a thread to this key level of support right here, right around 360. Now, again, we do have these recent lows down around 356. And if earnings are bad this week, we see a hot inflation print, there's more hawkishness out of the Fed minutes, well, then we're most likely going to see the market break these lows and potentially head all the way down to 350 or even lower. Now, again, we are seeing a little bit of declining momentum here with the MACD, but we still have RSI at pretty low levels here below its moving average, and ADX starting to pick back up on this downtrend. So again, guys, expect a lot of volatility. The name of the game this week is really going to be these quick scalps. Protect yourselves. We have a lot of different moving parts in terms of the news, earnings, Fed minutes coming out. It really doesn't make a whole lot of sense to subject yourself to any really extreme amount of risk. Now, again, as always, I do want to shout out a couple of people that are absolutely crushing it in our community. Black Betty, again, killing it, a 3% day. Red Ape over here, 4.92%. And what do we have here? Gabe having an absolutely crazy month, up 477%. So again, guys, if you do want access to all of these super powerful retail trading algorithms and all of the live streams, all of the curriculum videos, all of the alerts, make sure you guys check out that link down below. We say we're the best place to come and learn how to trade for a reason. Make sure you guys come check us out if you are interested. So moving on here, let's talk about this margin call situation. So global margin call hits European debt markets. Hedges blow up after risk gauges in Germany's government debt market exceed those of the 2008 world crash. Risk gauges in Germany's government debt market rose last week to levels higher than recorded in the 2008 world financial crash as margin calls forced the liquidation of derivative positions held by banks, insurers, and pension funds. Big institutional investors that spent the past 10 years insuring their portfolios or hedging against falling interest rates now face massive losses as hedges blow up. A key measure of market risk, the spread between German government bonds and interest rate swap agreements jumped above the previous record set in 2008. The cost of hedging German government debt with interest rate options or option implied volatility, meanwhile, rose to the highest level on record. The blowout in the euro derivatives market follows a near collapse of the British government debt or gilts market averted at the last minute by a £50 billion bond buying spree by the Bank of England. So we know that there are these significant margin calls happening over in the UK right now and over in Europe. Well, how is that going to fizzle over into some of the other things that we've been talking about here? But one, we do have to talk about this British government debt situation because their little quantitative easing spree is starting to backfire in their face. If you look at this chart right here, despite the Bank of England promises to do almost, quote, whatever it takes, long-dated gilt prices are collapsing today. 30-year gilt yields are up a stunning 34 basis points now, soaring towards crisis highs. Remember, there was a lot of margin calls happening due to these pension funds and their exposure to the essentially the British government debt market, and the Bank of England stepped in to try to buy these government bonds at such a rapid rate to decrease the yields and increase the prices on these bonds. It's also known as quantitative easing. Now, we saw this initial drop, but even though they've continued this bond buying spree, well, you're starting to see the yields start to pick back up here. Now, they do have up until the 14th, and essentially what they've said previously is what they're going to consider the stopping of this new quantitative easing spree. And that's going to be another key piece of news that I want you guys to look out for. Are they going to extend this bond buying program that they have? Or are they really going to bite the bullet and let things kind of take its course over in the English markets? Now, that's going to have an effect on our markets too, because as you see these bond yields start to move, our bond yields are going to move too. So is our dollar, and that's going to have an effect on the United States equity market. Now, again, at this current time right now, when we are looking at the target rate probabilities going into the November meeting, we currently have about a 78.4% chance of a 75 basis point rate hike. Now, we're most likely going to be getting the 75 basis point rate hike, obviously, by these probability data metrics that are shown here. Now, what we also have to think about here is the target rate or the terminal rate that they're going to be taking the Fed funds rate to. The current target rate is about 300 to 325 basis points, with the terminal rate being in the range of about 450 to 475 basis points. So what's most likely going to happen is we're going to go up to those levels in terms of the target rate for the federal funds rate, and then the Fed is going to make a decision as to whether or not they want to leave interest rates where they are or even increase them further, because we have to look at all of the different data metrics that are coming out, inflation, the labor market, the unemployment data, to really give us an indication of what the Fed is doing actually working and having an effect on the things that it needs to in order to rip the Band-Aid off, wipe the slate clean, and get us back to where we need to be in order for us to see some of that long-term growth. Now, I do want to talk briefly about some of these comments from Jamie Dimon too, because these statements are kind of in line with everything that we've been talking about over these last couple of months. JP Morgan Chase CEO Jamie Dimon said the U.S. economy was, quote, actually still doing well at present, and consumers were likely to be in better shape compared to the 2008 global financial crisis when the world tips into recession. But you can't talk about the economy without talking about stuff in the future, and this is serious stuff. His comments come at a time of growing concern about the prospect of an economic recession as the Federal Reserve and other major central banks raise interest rates to combat soaring inflation. So what he's essentially saying here is that, well, the U.S. is likely to tip into an actual recession. Remember, the actual textbook definition of a recession is 2 declining quarters of GDP, and we have had that. But for the regulatory bodies and the White House to actually come out and say we are in a recession for sure, well, there's going to be some other data points that need to come out in that direction as well. And Jamie Dimon is projecting that to happen within the next 6 to 9 months. But what I really want to get across to you guys is that we are nowhere near out of the woods yet. And especially with where we are this week and in terms of the amount of volatile moves that we could potentially see, remember, we're starting to see the kickoff of earnings season. Now, with everybody starting to talk about Credit Suisse, UBS, and the credit default swap spike in a lot of these large financial institutions, it's going to be very interesting to see how these companies are actually doing financially when they report their earnings. Now, again, earnings season is in general going to lead to a little bit more volatility in the overall market, because if we start to see what we may want to call black swan events where these companies miss significantly on their earnings reports, it's going to take the market down with it. Now, think about where we've been and where we're going. We have seen some of these layoffs. You might end up seeing increases in margins by some of these companies that have actually laid off some of their staff. But this earnings season is going to be critical. Remember, Fed minutes coming out on Wednesday too. And thinking about the situation as a whole, I say this a lot, but I want you guys to keep thinking about this. When you look at the news coming out, the data points coming out, are these things helping us get in the direction of things getting back to some sort of normalcy, or are they neutral, or are they pushing us back in the wrong direction? Most of the things that have been coming out, they're not great. And we know where the Fed wants to take their target rates. We know all of the data points that we are looking at and how to read them. And it's really kind of up to how the market wants to decide and take these different pieces of news and data as they come out to give an indication as to where price is going to go. But again, keep yourself safe. It's going to be an incredibly volatile week. There's really no need to take on any aggressive amounts of risk. The name of the game is going to be quick scalps. So guys, that is going to wrap up this video here. If you did enjoy the information and analysis that I provided for you guys, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great start to the week. I'll see you guys in the next one. Peace.